morning, everyone. Thank you for joining. As you can see, today's session is going to be on bringing risk appetite to life. My name is Sandie O'Leary, and I'm Head of Risk Advisory at calQrisk. I know there's a large number of people registered for today's session, but I am also conscious there's a lot to cover in this morning's session. So I'll get started with the introductions as people are continuing to register and join, if that's okay with you all. As you know, it's being recorded and we'll be circulating the slides at the end after the event in any case. So as I said, today our topic for discussion is going to be bringing risk appetite to life. As you know, calQrisk, we deliver a number of webinars over a range of topics. And my name is Sandie O'Leary, and as I said, I'm head of the risk advisory area in calQrisk. I've been working in risk management, I suppose, for 17, 18 years now, and I've seen its role in organizations grow and mature over those years. And I'm a huge advocate for risk management, basically as a key contributor to long-term organizational success. But core to achieving that is ensuring that everyone in the organization, no matter which organization you come from or you're employed in, understands the role that risk appetite, tolerance, and capacity, those three together, play as foundational elements of a strong risk management framework. As I say, you know, as a firm, we're very experienced in the risk and compliance area. We offer governance, risk and compliance solutions and services, and there's loads of information available on calQrisk if you want to have a look at it separately. This webinar, as I mentioned from the outset, will be recorded and the slides will be circulated along with a link to the recording. So today, what are we going to do? Today's 45-minute session will take a practical look really at the concepts of risk appetite, risk tolerance, and capacity combined, and how they help to guide organizations, if you like, along the right path to achieving their own goals and objectives. I'm going to go through the basics initially, and then I'll look at how risk appetite works in real life. And we're going to look at examples across 4 sectors. I'm going to look at lending, charities, insurance, and public sector at a high level. I'm conscious there's a lot to cover in 45 minutes, so I plan to address any questions that you have at the end, hopefully, if that's okay with you. And I'm more than happy to continue past the 45 minutes if people still have questions and we're not covered within that initial time slot. So today, what are we going to look at? We're going to try and address the questions around what does risk appetite mean? How is it expressed? What might it look like in real life? And what can cause it to change in the real world, which I think is a key element of this. So risk appetite at its core, what does that actually mean for us all? It's defined as the amount and type of risk that an organization is willing, and that's important, is willing to pursue, retain, or take to achieve its objectives. Kind of sounds simple enough, doesn't it? In a definition like that, I suppose risk management sounds straightforward, but in reality, it is a very challenging concept to fully understand and to put into practice. By a huge margin, it is the topic I'm most asked about in my role as Head of Risk Advisory in calQrisk. It's intended to reflect the organization's intention, if you like, with regard to what's an acceptable level of risk for it to take on a normal basis, basically in pursuit of its own defined goals and objectives and values. The most important thing to remember, I think, is that the purpose of a risk appetite statement is to allow people at every level of your organization to make decisions that don't involve taking too much risk or more risk than your organization is comfortable with, but also has the flexibility, if you like, to allow them to take sufficient risk to achieve your organization's goals and objectives. The risk appetite statement is more about, I suppose, setting the guardrails, if you like. And this does require a lot of thought and effort to get it right in practice. And there are a few layers to it, and that's what I'm going to address today. I suppose at its most basic, risk appetite is expressed usually in one of 4 terms. It's either 0 or very low risk appetite, moderate, or high. As I say, there's generally only those 4 options, but an important thing to note, I suppose, from the outset is that the lower your risk appetite for anything, the more controls that are going to have to be put in place to prevent that risk from materializing. If you commit to a certain level of risk appetite, you have to be able to follow it through. As I said, the 4 levels I've just outlined in the slide there. The 0 to very low risk tolerance one is, believe it or not, the one most people seem to struggle with. The challenge arises, I suppose, really around defining this concept of zero risk appetite when there are often factors at play which are not within the organization's ability to control or to fully mitigate. So for this reason, many organizations, I suppose, tend to opt for very low rather than 0. And ultimately, this really comes down to a question of language. The word appetite itself in this context can be confusing. Its literal definition is that it is a strong desire or liking for something. So, for example, it would seem perfectly reasonable to say that your organization has a 0 risk appetite for knowingly breaching legislative compliance requirements, with the stress here on the word knowingly. On the other hand, if you say you have a 0 risk appetite for fraud, for example, then you have to be sure that you have the ability to achieve that. I've seen lots of internal auditors over the years push back on organizations who say, for example, that they have a 0 risk appetite for money laundering, as an example. As in a lot of ways, the organization does not necessarily know all the facts or have full control over the situation or the transactions involved. But many people struggle with the language here because it doesn't seem right for an organization to say that they have a low risk appetite for fraud, which kind of, if you take it literally, sounds like they're saying that they have a desire or liking for a certain level of fraud, which we know is not the case. So if you take, for example, an institution that takes in savings, there's a limit to how certain they can be that those funds, those savings, are not the proceeds of crime or tax evasion. So you could either go with a 0 risk appetite for something where you particularly might phrase it for knowingly facilitating whatever the undesirable activity might be, or you could go for phrasing it as a very low risk appetite for that activity. Either way, whichever you choose, I would say it's good to have a brief rationale behind that high level statement to explain what you mean by the chosen option. Low risk appetite then comes in for, often things such as certain types of operational disruption, for example, routine systems maintenance and things like that. Or you might have a particularly cautious approach to things like maintaining assets in liquid form, for example. You might like to avoid certain types of investments if they don't align with the organization's culture or ethos. You could have, certain insurance companies maybe have a more risk-averse approach and therefore, choose their product offerings accordingly. When you think about a more moderate risk appetite, that's often in relation to maybe newer innovative strategies in order to pursue your goals. So, for example, a lender might introduce a new loan product that requires maybe specialist knowledge to underwrite it. An insurance provider might introduce a new insurance offering, for example. In recent years, you would have seen a lot of change in the areas of cyber insurance, for example, and it might be maybe climate-related insurances. Again, these are changes. These are, maybe venturing into new areas for an organization, so it might require them to take a little bit more risk than they would have traditionally. High risk appetite examples might be where, an investment product, for example, which might have the potential for high reward, but then also has that counterbalancing risk of loss of the investor's funds. You could also think of it in terms of insurance companies who insure maybe new or untested technologies, for example. Many public sector bodies are set up specifically to deal with areas of moderate or high risk. And these are, the public sector bodies come in because private organizations wouldn't have the risk capacity to deal with it. So therefore, the state steps in. Many charities, as we know, operate in high-risk environments. And so the higher the risk, the more controls or protocols that would be put in place in order to mitigate the risk. So these are kind of the 4 levels, if you like, at its highest level. In terms of risk categories itself, then, risk appetite is determined by, I suppose, the organization's leadership, the board of directors, whatever that management group might be. And it can be across a range of sectors, and they will very much vary depending on the type of organization. And I know today we have organizations from multiple sectors in attendance. So I'm trying to give examples across a variety of sectors for this particular session. More common categories would be things like you see there on the screen: governance, operational, financial, conduct, strategic, environmental, credit, reputational, and so on. And I suppose at the end of the day, it's important that every organization understands the risks that it might be exposed to, that it maybe currently is or might be exposed to in the future. And it is important to remember that a lot of risk management is about trying to anticipate what is or might be coming down the line. It's not necessarily entirely about what you're currently exposed to, but it is most definitely about keeping an eye on the horizon and seeing what might impact you in the future. So that breadth of range of topics and categories is important because change can come from a range of directions, and we'll talk about that later in the session. For the purposes of this short session, we're going to assume that every organization that's online today is aware of the risks that it is or might be exposed to. But you also then have to have your own strategic goals and objectives in place so that you can start to document how much risk you're individually willing to take in order to achieve them. And this documentation of how much risk you're willing to take forms the core, if you like, of the risk appetite. Sometimes risk appetite can involve making trade-offs between the various categories and the strategic choices. And a lot about defining your risk appetite is about making clear where the trade-offs are, and so that you can provide, as an organization, clear guidance on priorities. And as I said, this is going to vary from organization to organization. The main message I would try to get across today is that risk appetite on its own can really only be understood once you relate it to risk tolerance and risk capacity. These three concepts, to my mind, are inextricably linked. And risk appetite really only comes to life when you build in tolerance and capacity. So what are they? What is risk tolerance? It is defined as the level of risk that the credit union, that's an error on my part, but I was going to say that I'm used to speaking to credit unions quite a bit, that the organization is prepared to tolerate before action must be taken to reduce the risk. Unlike, I suppose, the word appetite itself, the word tolerance is easier to understand and apply in this context. It infers a certain reluctance, but also a willingness to accept that there are desired limits to risk-taking and risk minimization. These tolerances can take the form of upper and or lower limits. It also signifies that there must be a willingness to take some risk if the organization has any hope of achieving its goals and objectives. Risk tolerance really is a refinement of that higher level risk appetite. It translates that high level statement into practical guidance. So it has to be organization specific in order to be relevant and useful in practice. So it is absolutely critical that every organization documents its own risk tolerances. And that usually involves setting out kind of like quantified limits on the level of risk that you might be able to accept in pursuit of your strategic objectives. And you can look at these in both quantitative and qualitative terms, but they would be normally defined per category as each category applies to your own organization. So how are risk tolerances expressed then? I'm going to take the next few slides to just give some examples of how you might see risk tolerance being expressed. The first example I have there is kind of, there's a bit more text to it because I wanted to make it clear what I'm getting at. Lots of regulated entities are required to hold a minimum level of capital by law. So it's perfectly reasonable to state then in your risk tolerance statement that you have set your minimum legislative requirement as your minimum tolerance. Usually, and this is where tolerance can be a little bit flexible, in many organizations that have a legislative requirement in this regard, they might add in an extra buffer to act basically as a trigger point at which your organization will take action should your capital, for example, start to come under pressure. So a lot of times your tolerance would be above your legislative or regulatory requirements, just to give you that little bit of a comfort buffer zone. In terms of other examples, conduct risk, for example, if you look at examples might be for the unfair treatment of consumers in vulnerable circumstances. And this is obviously particularly relevant with changes to the Consumer Protection Code recently, but also, it's been part of the Consumer Protection Code for quite some time anyway, but the interpretation of vulnerability has changed. In terms of zero risk tolerance for mis-selling of products or services to maximize your sales and incentives bonuses. So again, that has happened in the past, and where products and services have been missold because the structures of these types of incentive programs led to that situation. So therefore, you want to avoid it. Organizations, another example would be where you might tolerate a certain number of complaints per month, per quarter, per annum. Depends on your industry, depends on what the norm is, and ultimately, are you learning from your mistakes? So it's not about tolerating them and not doing anything about it. It's about learning from it and ideally improving over time. Conduct risk is a good example where a lot of the tolerances would probably be more qualitative than quantitative in nature. Governance is another category. So you might, for example, have zero risk tolerance for knowingly permitting conflicts of interest in board decision-making processes. Notice I do link the word knowingly a lot of times with zero risk. If you want to rephrase that as low risk tolerance and so on, you can, or very low risk tolerance, you can do so and provide your rationale as well. You might have zero risk tolerance for knowingly falsifying records, reports, or data submitted to an industry regulator. Now, in this particular instance, knowingly, the word falsifying by definition means you've actively chosen to do so. But again, just by habit, I tend to include the word knowingly. In terms of liquidity, similar to the capital one, there will often be, for certain sectors, there will be minimum requirements for liquidity. So again, you're talking about stating that the legislative or regulatory limit might be your minimum tolerance, and you might build in a buffer to act as your trigger point for action. Operational as a category, you might have zero or very low risk tolerance for fraud. You might have a low risk tolerance for employee underperformance, for example. And where it arises, you'll seek to address any such issues with additional. The case may be to bring that person up to the standard that you expect. You might have a low risk tolerance for replacement of ICT assets, for example, on a rolling basis appropriate to each type of asset and to the business needs. In terms of strategy and strategic risk, you might have a low risk tolerance for discretionary business decisions, and that are maybe counterproductive to the achievement of your strategic objectives. Kind of a high level statement, but it does get the point across. If you think of credit as a category, you might have a maximum loan size that can vary again depending on the type of risk you might have associated with particular loan types. So if you're offering secured loans, for example, they're lower risk, so you might have a certain loan size attached to that type of product. Credit card debt loans are more moderate risk, so you might have a more conservative approach to the maximum loan that you might offer in that situation. And payday loans might be a higher or would be a higher risk loan product. So therefore, you might, again, have a different loan maximum in order to manage the risk exposure for the entity. Concentration limits on various types of loans are intended to spread the risk across your loan types and the level of risk. And so therefore, you can have different ones depending on the type of loan that it might be. From an insurance category perspective, you might have zero risk tolerance for the mis-selling of insurance products. You could have concentration limits on various insurance products in order to spread the risk, as we've given examples earlier where some products are higher risk than others. You might have a maximum, again, number of complaints that you'll tolerate in a particular period. With regard to investments, you could have limits on your investment portfolio concentrations by risk category, by institution, by counterparty, etc. You could have zero risk tolerance for breaches of investment regulatory requirements. Again, organizations are more likely to put in a little buffer above that so that, again, they can trigger action if they need it. So risks within an organization's risk management system should be managed and mitigated to make sure, basically, that they're consistent with your risk tolerances. And ultimately, as a lot of the academic definitions say, that they're commensurate with the sound operation, financial strength, and strategic objectives of the specific organization. And we're going to look at risk capacity next. We try to provide guidance on when those constraints around sound operation, financial strength, and strategic objectives start to come under strain, or worst case, might be breached. So risk capacity then is the maximum amount of risk which an organization can afford to take before its financial viability is threatened. its mission becomes unachievable, or operational integrity is jeopardized. So what does risk capacity look like in real life? I'm going to give a couple of examples in this slide and the next around how you might express risk capacity. So in financial terms, for example, how much profit or surplus does your organization have, which will allow you to absorb the costs if a risk were to materialize unexpectedly? It is important that you have clarity on this, for every organization. This is kind of, I suppose, the most basic one. You might look at your strategic and business model and say, how much income do we need as an organization to be generating so that we can pay for the running costs and generate a surplus or a profit or a dividend, whatever it might be for your type of entity? In terms of capital, how much capital does your organization require? Because some will have regulatory requirements in this regard, others perhaps not, but you still need to have a good feel for what base level you need to be at in order to meet your ongoing and future business needs. So again, that's reasonably easy to quantify. In terms of liquidity, again, that's a similar one in that some organizations, if they're heavily regulated, will probably have regulatory requirements around liquidity. But even if you don't, if it's not a requirement for you, you should have a strong understanding of how much liquidity you need to deal with your short-term liabilities, basically the cost of running the business. And that one, again, is usually a bit easier to quantify than others. In terms of governance, are you experiencing in your entities challenges, for example, recruiting candidates for the various roles that you need, particularly in a governance and leadership capacity? And I know in particular, this can be an issue for charities. What happens, if a key person that you depend on leaves? This happens, as I say, a good bit in charities where the leadership the charity itself might be very closely associated with the specific leadership. And you have to be planning for what was going to happen if they decide to leave or if they retire and so on. From an operational sense, then, is the organization sufficiently resourced across all the functions that you need in order to deliver your mission or your strategic objectives? That can include things like appropriate qualifications for the various roles, appropriate level of experience in specific roles. Time is something we often don't consider, and human resources themselves. If you were to experience a negative risk event, would you have the capacity within the human resources that are available to you to respond to that? Or do you know how you would gain access to them? Is there an additional resource that you can call upon in an emergency situation? And from an operations perspective, it's also good to know if there's any known future costs, if you're going to have to significantly invest in something in the future in order to make your organization viable, or is it a hard limit on your risk capacity? So these things are always good to have documented and to know in advance. So how do the three then relate to each other? We tend to think of risk capacity as where the organization is operating on a day-to-day basis. It's within its comfort zone, if you like, when it's operating within its risk appetite. The risk tolerance zone, that green one there, that slightly bigger circle, is where your organization might be willing to go in order to achieve a specific goal or a specific objective. You don't want to be out there all the time, but you want to be capable of dipping in and out within your tolerances, reverting back to your appetite in a business as usual sense, but occasionally expanding out into the tolerance zone where you can go without material negative consequences on your organization. Your capacity is really the absolute outer limit of where you can go, where the organization can go without instigating those negative consequences, without putting major questions upon the viability of your organization. So that's how the three relate to each other. So we're going to have a look at what risk appetite looks like then in real life. I would say that to achieve an organization's goals, as I say here on the slide, everyone needs to understand how it applies to their individual roles, not just the organization collectively, but to their individual roles, irrespective of what position they fulfill within the organization. In order for, I suppose, every organization to achieve its goals, I think you want to be trying to get everyone rowing in the same direction. And that basically means that everyone has to have a clear understanding of how the risk appetite set by whoever's governing the organization will impact on the delivery of their own role. So in the next few slides, I'm going to have a look at a few case studies of how risk appetite should filter through in the delivery of the organization's products and services and adapt where necessary. I'm going to look at a couple of threads across a few specific sectors to illustrate how the risk appetite filters through, as I say, from strategy to delivery. And I'm going to take an example and follow a thread through a lender, a charity, an insurer, and a public body. But I would say from the outset, irrespective of the sector, the process is the same. And that's what I'm trying to communicate today. And I think everyone will benefit from each, even if it's not the organization you're working with, you'll recognize it in the other sectors. I do believe that developing and implementing an organization's risk appetite takes place across 3 layers ultimately. You've got the strategic planning layer, then you bring in your guardrails, and then the risk appetite starts to become put into action. And that's how we bring it to life, by taking it through those 3 layers. So you'll see for the next set of slides, there's 3 slides for each of the sectors which illustrate those layers. So starting with the lending institution as an example, again, I'm just following a thread now through each of these. This isn't all of it. And these bullet points are really just statements, that would be there for illustration today. They would need to be more fleshed out in real life. And I'm just using them for illustration, really. If you take the lending institution, for example, they're going to have choices with regard to what credit market you want to get into. And that will, again, come back to how much risk you're willing to take. So just as an example, you might be involved in small to medium secured and unsecured personal loans, which is kind of the lower risk end of the scale. You might get into large secured loans, large unsecured loans, small to medium business loans, large business loans, loans to startups, payday loans. Each of those options have a different risk element, if you like, or pose different risks to the organization. And your choice in that will determine everything else that comes afterwards, in terms of, if you see the green arrows there illustrate that it takes you basically go from one to the other to the next. So if you've chosen your credit market, you then need to put in place your strategic goals. Again, these are probably not what you would see necessarily in a lender's statement of its goals, because if you take the examples I've already shown there, maybe grow the loan book gradually, grow the loan book quickly, grow the higher risk or more complex portion of your loan book quickly. It's unlikely it states that there, but if it doesn't state it at the goal level, then it means that your risk appetite and tolerance statement have to carry more of the weight in terms of expressing that risk appetite to the others who need to know about it. So again, the organization will probably know itself which of those they're choosing to follow through on. In terms of credit strategy, then, based on what you've chosen, you might identify and monitor your lending KPIs. You're going to appoint appropriate resources, human and technical, to deliver them. You're going to want to recruit experts for specialized loan products. So these are strategies that you will take in order to achieve those, or to work towards those strategic goals based on the appetite that you've expressed at the beginning. The second layer is where we bring in the guardrails, and this is where risk capacity, appetite, and tolerance come in. So to put your strategic plans in action, you need those guardrails to be clear. The appetite and for credit risk will vary depending on the credit market you've chosen. And then keep harking back to, this does not appear out of nowhere. This comes back from the previous slide. So how much, when it comes to capacity, how much profit or surplus is available to absorb unexpected losses, for example, if the loans are not to be repaid? How much of a buffer exists between the cost of offering the loan product and your current interest income? So these are illustrations of capacity. There will be others, again, depending on the organization. Credit risk appetite then follows on from your capacity. If you have a decent amount of capacity, you might take a moderate, well, everybody has to take a moderate appetite for credit risk, to be fair. You can't really get into lending without having a reasonably moderate appetite for risk. But you might determine whether you have the capacity to go into high risk, high credit risk activities. And again, one will influence the other. Depending on your choices in terms of your risk appetite and the products that you choose, based on that, you will have tolerances. You'll set your tolerances. It might be a maximum loan value. It could be the maximum loan value per loan product, and that because the products themselves vary by risk. You might set lending targets as an organization. You might have a maximum proportion of your loan portfolio that you're willing to lend out in those higher risk loan products. And it's all relative. Even if you were to stay within a moderate credit risk approach, there will be some loan products that are lower risk, some more moderate. You might have a maximum tolerable loan arrears limit by product. So remember, the risk tolerances can be per loan. So a large loan defaulting could cause a disproportionate knock-on effect on a large group of loans, or a large group of loans could be affected by a risk event. So, the collective negative impact could be significant to the lender rather than the individual large loan impact. So you do have to think about it from a number of different perspectives. So the third layer then in this illustration is where you start to see the risk appetite in real life. It's where you start to see it go into action, if you like. The guardrails we identified in the previous slide should be visible on the ground. And remember from the outset, as I said, remember the lower the risk appetite, the more the risk mitigation measures will be required. So when we start to look at it in action, then we think about it in these illustrations from three different perspectives. Firstly, governance and oversight. So the governing body, whatever organization it is, needs to communicate what risk appetite it approves through its policies, and that can be credit and credit control policies and so on. They'll communicate that through the management information that the governing body expects, because they want to monitor the progress that you're achieving or lack of progress, as the case may be. I'm going to use the term three lines model throughout all these examples, and that refers to the three lines of defense, if you like, in terms of risk mitigation. You've got the people at the front line reporting to on how things are going. You've got people on the second line of defense, which would be likely to be your risk management officers, your compliance officers, your internal audit. Your third line will be your external audit, or an independent assessment body that again reports information back up to the governing body. So that's part of the framework of governance and oversight. Then you'll translate your risk appetite into your lender role requirements. For example, as I said, I'm following a specific thread here in terms of the lending. You might have minimum qualifications for your loan officer role. You might have the experience that's required to perform the role. It might be specialist knowledge or qualifications that are required. For example, in business loans, you need a certain type of experience and knowledge and qualification in some situations. And that then translates into the next level, which is your lender operational guidance. So that'll include things like your detailed procedures by loan product, might be loan approval limits by exposure limit, by level of exposure. It might be your loan underwriting criteria. So, debt to income, for example. It could be lending outcomes that you're wanting to monitor to make sure that everything is going as it should. Things like arrears, rescheduling, provisioning, and so on. So these are the three layers. I'm going to have a look now at an example of a charity. So I haven't been as specific in the thread here because the charity sector is so varied. So I've really tried to use some general examples that everybody can learn from in this illustration. So the charity should first think about obviously what its mission is, and that's the cause that you're looking to address, identify the action that you intend to take to achieve that mission. And it does describe usually the desired outcome. What is it you're trying to achieve? Through that, we translate that into your strategic goals. And for a lot of charities, they would include things like increasing your reach, increasing awareness amongst the people you're trying to reach. It could be something like raising sufficient funds to deliver the service. It will be recruiting staff and or volunteers, depending on the charity that you're operating in. It could be about generating positive media coverage. And based on those goals, you'll then have related strategies like a marketing campaign. It could be how you're going to increase your donation channels. It could be organizing fundraising events. It could be your volunteer recruitment drive. So that's your top layer in terms of the charity sector. The next layer, where you introduce your guardrails to outline your appetite, you begin with, again, your risk capacity. Do you have enough of a surplus available to absorb unexpected risks? What liquid assets can be called on if you need them in an emergency? How limited are your source of funds? Is there concentration risk there? And this refers both to the number of, as in the size of the funds, and the reliability, or the number of sources that are available to you. How sensitive might your charitable organization be to reputational damage? That then translates to your risk appetite. Again, you might have a very low risk appetite for non-essential expenditure. That would be quite common in most charities because funding is scarce. You would have a moderate risk appetite maybe for the source of funding concentration. And the reason I put that in there is that sometimes charities are very limited in their sources of funding. And ideally, you want as wide a range of sources as possible in order to mitigate the risk if there were to be a problem with any one source. But in a lot of charities, they don't have an awful lot of choice. You might have a very low appetite for reputational damage. We know that a lot of charities rely on goodwill and their good reputation to be successful, to achieve their mission. You might have zero risk appetite for breach of service user personal information security, for example. I'm just, trying to give examples that would be common across the charitable sector. You then translate that risk appetite into your tolerances. So in order to again, make it clearer, you'll set budget limits maybe for your marketing campaigns. So you want to make sure that you're not spending so much on your marketing that it impacts your service delivery, for example. You might set a maximum investment, amount or proportion for technology for engagement, for donation channels. Again, it'll depend on your own situation. You'll decide how best to approach it. You might have a maximum cost per fundraiser that you recognize that depending on a certain type of fundraiser, if the cost goes above it, you're not going to generate sufficient income to make it worth your while. One question is always in the charitable sector is how much reputational damage could be sustained? What does this looks like? What does, and this is where your tolerances come in. What does bad look like? What does very bad look like? What does the point of no return look like for you in your particular sector? And then layer 3, in the charitable sector, we're talking about putting them into action through, again, same levels, governance and oversight, your role requirements, and your operational guidance. Firstly, from the governance and oversight piece, your trustees might communicate your risk appetite through the various policies. For example, again, I'm following that thread that I used in the previous slide. They'll start to communicate through your marketing plan, the IT policy, your recruitment policy. The trustees will set the tone, if you like, for the level of risk that they're willing to accept throughout. And they usually do that by leading by example and insurance accountability. And again, coming back, we will employ the 3 lines model in this sector also. You'll see this repeated in all of them. In terms of general requirements, you might have fit and proper as a requirement for all people actively involved in the charity, and in particular roles, especially high profile roles. You want to make sure that people meet the definitions of fit and proper for the organization. You might have clear role descriptions. There will be resources allocated for each role appropriately. You might have to appoint specialists in particular roles, where necessary. There might be role-specific training. Again, will depend on the charity and the activity that you're engaged in. When it comes down to the operational level guidance, that will translate into, very strong financial controls and monitoring, procedures for fundraisers, maybe health and safety protocols. It could be public relations guidelines, could be communication plans for risk incidents. So again, these are examples of what risk appetite in action on the ground will look like, having translated from all of the previous steps. I'm now going to look at it again similarly from an insurance market perspective. And you'll see, again, everyone should be learning from the the process here. So an insurance market, you might have various options like property, life, cyber fraud, marine, climate, and so on. They'll all have a different level of associated risk. You'll choose your strategic goals based on the market options that you've gone for. And more common goals would be like business growth, it could be customer retention, and it'll be operational resilience. From a strategy perspective, you'll be looking at monitoring your customer outcomes. You want to make sure, for example, that your operational resilience infrastructure is strong so that there isn't interruption to service delivery. That will translate then to layer 2, your guardrails. So from an insurer's perspective, the risk capacity could be defined by how much funds or much profit exists in order to absorb the losses, unexpected losses. How much of a buffer above the regulatory capital requirements do you have? How much of a buffer exists between the cost of offering the insurance product and the associated income? So these are limits, these are indicators that you can use to illustrate the capacity of the insurance company organization. That then, as I say, depending on how you go and where your capacity is, you'll set your risk appetite. So examples might be that you'd have a zero or very low risk appetite for legislative or regulatory non-compliance. You're most likely to have a moderate appetite for risk generally, because that's, to be in the insurance sector, that's fairly, that would be fairly common. Some might have a higher appetite for risk. So you might be going into more specialized areas of risk, like cybersecurity or ensuring new technology. Again, depending on where your appetite is, you'll translate that into your risk tolerances. And examples might be where you have a buffer above your regulatory capital requirement. You might set a maximum limit for the percentage of premiums that are paid out as claims. You might have a minimum percentage of customers that you want to retain. You might have a maximum number of, again, customer complaints per period. So these will depend, one is dependent upon the other. And when you translate that into action or bring it to life, in an insurance sector, you're talking about a governance function that would communicate this through your relevant policies, whether it's the underwriting policy, it could be your risk management policy. The oversight and governance functions will look at monitoring the key performance indicators that you've chosen for your organization. And again, we'll bring in your 3 lines model. If you think about an insurance underwriter role, again, you would expect them to be fit and proper for the role. You would expect them to be appropriately qualified and experienced. You will require certain specialist roles to have a certain level of qualification and experience in order to deliver those specialized insurance products. And a good example of, a requirement in this sector would be consumer protection training. When it comes to the underwriter's actual day-to-day bringing to life guidance, they'll have role descriptions. You'll have underwriting criteria for each insurance product. You'll have minimum compliance standards. You'll have performance KPIs. Again, one leads onto the other, which is the point I'm illustrating. And the 4th example is around a public service body. So public service body, many of them are set up to deal with a risk that's already materialized in the public domain. Ultimately, that's often the case. And the government or state has had to intervene in order to mitigate that risk. It could also be an entity that's set up to deliver a public good, for example, a regulatory authority or an area of education. So I'm going to look at, again, kind of general examples that I think will apply across the board for a public entity. But, if you take, for example, education, the mission might be to educate the public in a particular area. The goal might be to educate as many people as possible on a particular topic. It might be cybersecurity, it could be financial literacy, while minimizing the cost to the state. And the strategy might be to design and offer specific courses to as wide an audience as possible. But in general, for public bodies, you're going to have your mission, which is your purpose and reason for being, the value proposition, not usually profit, so it'll be whatever value that organization is intending to bring. And it'll describe your outcome desired, that is desired. That'll translate into the strategic goals. So usually there's leadership involved somewhere, leading by example, setting or creating the space for certain things to be achieved. It will increase awareness is usually a key strategic goal for most public bodies, providing assurance to the stakeholders, and that can be stakeholders in terms of the service users and the people who, the government, the state, who determined that it should be set up in the first place. A strategic goal is usually to provide transparency in how they're delivering on their mission, and ultimately about delivering positive outcomes based on the reason that their reason for being, if you like. Strategies in this case will usually include engaging, again, suitably qualified experts to help deliver the value proposition that was established in the mission. To deliver public information campaign, be about maximizing the channels of engagement. It could be about monitoring outcomes. So again, your strategies will be more fleshed out depending on the individual public service body that you might be operating in. So then what does that look like in terms of capacity, appetite, and tolerance, instead of in the sense of the public service guardrails? So to deliver on the goal and strategy, you need to know how much you can afford to lose, basically, if things don't go according to plan. In the education body, for example, if a course does not get the anticipated take-up from the public, what happens if more people than anticipated apply to complete the course? Is there funding available to expand it? How will the body respond if the first course graduates aren't happy with the outcomes that they received? What effect could that have on the entity in terms of its reputation? So risk appetite is more likely to be linked with, I suppose, value when it comes to public service bodies than purely financial measures. And there's also the political element, I suppose, in a lot of public service body operations as well, that has to be taken into consideration, because that's very closely linked to the reputational damage piece. So when you think of capacity, as we're talking about funds available to deal with those unexpected risks, liquid assets, you could call on an emergency, where you might get additional sources of funds, how reliant are they on a particular concentration in terms of source? How sensitive is the organization to reputational damage? There can be, and again, it often happens in public body scenarios, there can be a situation where the body itself was set up to deal with the heightened risk of, to deal with a risk that has already materialized. So there is, by definition, an associated reputational damage. If you think of, for example, the houses that suffered from the pyrite damage. So the Pyrite Resolution Board was set up specifically to deal with an issue that already has quite a challenging risk environment, in that the risk has already materialized and there's a lot of reputational damage at stake. In terms of then translating the risk appetite to the risk capacity into appetite, you might have a zero risk appetite for compliance breaches, a low or moderate risk appetite for reputational damage. You could have a very low risk appetite for budget overspend, because it might be definitive for a public body. That's the money, that's it, no more. In terms of translating that into risk tolerances, then you could have a maximum number of complaints in a period. You might have minimum response times for inquiries. You might have a minimum number of issues addressed or cases closed over a particular time, or the time taken to resolve individual cases. You might have a minimum take up on the service offering. So again, these will be good guardrails to put in place. In terms of it getting translated then into action, how do each of these filter through? So you'd have your governance and oversight element, where the board communicates your risk appetite through policies. The appetite itself can vary very much depending on the purpose for which the public body was set up. Again, you'll have your 3 lines model. Role requirements: fit and proper to perform the role, to deliver the service. Role descriptions: each role appropriately resourced, specialists appointed where necessary, and you would have role-specific training. In the on-the-ground delivery piece, you'll have consumer protection guidelines, probably. You'll have complaints handling procedures, more than likely. You'll have stakeholder engagement procedures. You'll have training on the various areas. So again, the range of public service bodies is enormous. So I've taken a general examples to try and see that thread through the 3 layers. So those are the 4 public sector bodies, if you like, 4 industry sector examples. So what can cause risk appetite to change? Lots of factors, can cause it to change. Economic factors. The next few slides are just some examples. You can have a look at them as you go afterwards. Realize I'm quite tight on time, but these will give you some good examples of where risk appetite can change when you, in different circumstances, economic factors, strategic factors, market factors, business model changes. It can be your financial health will impact your capacity immediately, your legal and regulatory environment. So to sum up, basically, I would say developing and maintaining a risk appetite statement is all about striking the right balance between appropriate and affordable risk taking and seizing the right opportunities at the right time in order to protect the organization's future. There's lots of things that can impact on the organization's risk appetite and tolerance, and that will include vision for itself. Where does it see itself in the future? What's it prepared to risk to get there? Your capacity to absorb risk within limits and tolerances, which again can change, as you'll have seen in the last couple of slides there. Leadership approach to risk, some more conservative than others. Your current financial health and long-term viability, your current and future business model operation aspirations, and your legal and regulatory environment. And finally, your economic and business environment. Changes in all of these are going to affect your organization, and therefore your risk appetite statement, including your tolerances, will need to be adjusted. And that's the key thing. It doesn't remain static. You need to be aware of the fact that it can and will change, and you need to keep an eye on it in order for it to inform your activities as an organization, to see it operating in real life. So I've covered, I know I skipped through, I suppose, the second last, triggers for change. If anybody would like me to go back to that, I'm more than happy to. If you have any questions you'd like me to deal with before I do that, or not as the case may be, please fill it in the chat. I'm just going to have a look there. Whoops, just to see if there's anything in the chat. No, nothing in the chat. Let me just check. There's something in the Q&A. 1 second. First question. This may have been answered as part of the webinar today, but would you have any opinion on using an annual board survey to help determine what risk appetite should be, or how do you recommend the board be as involved as possible in setting the risk appetite statement? Yeah, I think an annual board survey, I suppose, does, I'm trying to think, it performs a number of different reasons, a number of different purposes, should I say. And yes, you could certainly address risk appetite as one of them. I'm not sure. It depends on the organization and how detailed your risk appetite statement is, I suppose, because some things are likely to change for some organizations, depending on the environment that they're operating. The triggers will happen more frequently than others. For other organizations, the triggers are probably less common. So it really very much depends on how changeable your environment is. And if the environment that you're operating in changes, along the lines of the triggers that I outlined in this maybe third or fourth last slides there, then yes, it would be a good idea, I think, to do an annual survey, just to basically kind of ask them to think about what has changed in the past year. What do they know of that's likely to change in the coming year? So I would say, yes, it probably would be a good idea, again, depending on how prone to change your sector or your organization might be. I do think involving the board can be challenging if it doesn't change that often, because they often look at them and go, but nothing's changed. It is what it is. But I think the conversation is important, even if you were to take some of the points we've highlighted there and say, and use that to inform a conversation with the board at a specific meeting at least once a year, so that they're not just ticking the box to roll over the risk appetite statement. Generate a discussion around it, and use maybe some of the examples I've used to kind of highlight why this statement is important for the whole organization. Hope that answers that question. With cyber threats constantly evolving, is it not impossible to state low risk appetite even with strong controls? Yeah, I would agree. And I think I mentioned cyber threat even in the insurance sector as being one of the high risk activities, because I would agree with you. There is, but you can have, I suppose, again, it comes back to a language thing. You can state you have a low risk appetite for it, but you would put in a rationale behind what you mean by that. It doesn't mean that you're not going to make every effort to, in fact, what it does mean is that you will make every effort to make sure, because you know how important it is for your organization. And maybe that supporting rationale, you could describe what you mean by low risk appetite or moderate risk appetite. It comes down to language at the end of the day. If low risk appetite can mean a certain number of disruptions, a certain length of disruption. So I would just say have a rationale behind it that explains what you mean by low or moderate in that particular case. Is the risk appetite statement written from the risk tolerance and capacity point of view? I think it includes both. You need to know what your capacity is before you can be very specific about your appetite, and even more specific about your tolerance. And I do think they each influence each other. Hope that answers that question. Please come back to me if it didn't. Can you explain the difference between risk tolerance and key risk indicators? Risk tolerance are your limits. So you can say, my limit for something is X percentage. But a key risk indicator can be something that's, it's more of a, how is it giving you a sense that things are not going as well as they should? You can be within risk tolerance, but your risk indicators could be negative in that you're still achieving, the result is still within your tolerance limit. But if it's rising, and if whatever you've chosen to monitor to give you an indication of how things are going generally, if it's a bad thing that's rising or it's a good thing that's declining, you want to know about it. So that's different to your tolerance. You don't just wait for your tolerance to be reached to kind of go, oh, right, we need to do something. Your key risk indicators are usually things that you're monitoring to give you a feel for how things are performing generally, so that you know whether it's inclining or whether it's becoming more negative or positive. I hope that answers that question. This comment is very helpful. Thank you. You're very welcome. How often would you advise reviewing risk appetite? I would say the absolute minimum is once a year, and that's as much just to keep the language fresh amongst the governing body. But it would really depend on how changeable the environment is that you're operating in. If you think about certain triggers for review, if those things are happening on a constant basis, or maybe unexpectedly, you wouldn't wait for 9 months for the risk appetite review to come around. You might say, oh my goodness, something has happened in the economic environment. It's triggered a massive negative effect. We need to review our risk appetite statement now, not wait for the 6 or 9 months or whatever cycle it might have been in to come around. So I would say it very much depends on how changeable your environment might be. But at an absolute minimum, I would say once a year, again, just to refresh, to explain how this is important to be set, how others learn from it, how this communicates throughout the layers of the organization. Yes, you'll certainly be getting the slides afterwards. How to communicate to the business, how our risk appetite relates to performance targets. If you think about the layers I just spoke about through those various illustrations for the sector, that's I think, because I did spend quite a bit of time trying to join the dots, if you like. And I would say start from the beginning. So depending on which sector, you'll see there's 3 slides for each sector. Start from the beginning, illustrate how your mission, your goal, as defined right at the outset, informs the next layer and the next layer and the next layer and the next layer, if you know what I mean. Your performance targets are the bit that brings it to life on the ground. That's the bit where you're communicating back through the dots all the way back to your mission statement. So I would say try and maybe use those 3 slides as an indicator of how you start with the mission and goal, and how it links to your performance targets. And that's why I took a specific thread, for example, in terms of a lender or an insurance underwriter, so that they can actually visually see how the original mission links to a performance target at the last box in the third slide. Hopefully that will help. Can calQrisk include categories of risk such as strategic market risk in its risk listing, broken down with specific areas which doesn't always suit reporting? Again, it depends on the sector that you're involved with. calQrisk is more than capable of breaking it up into whichever categories are most appropriate for yourself. Some industry sectors, as you know, calQrisk works with companies across multiple industry sectors. For some, it's very predefined as to what those categories are. For others, it's less defined, so you have the flexibility to break them down into whichever areas suit you. So I would say absolutely engage with the customer help desk, have a chat with the customer support people who are very familiar with working with people in different sectors. So they should be able to help you to get your reporting aligned, whichever way best suits your organization and your reporting structures. Is it the board's responsibility to prepare, review, and approve risk appetite, tolerance, capacity statements, or its responsibility is to review and approve? And if so, who is best people to prepare these statements? The reality is, it's like everything else, I suppose. When it comes to responsibility and accountability, the buck stops with the board. However, we also know that, for very good reasons, boards are drawn from a variety of different backgrounds, experience, knowledge. The contributions that they make to the organization are wide and varied and necessary. So they're not necessarily always, or all of them, in a position to actually draft your risk appetite, tolerance, capacity statement. But I would say that it is done in the cooperation with, your risk management function, presuming that you have one, or your management team, or your CEO, depending again on your structure. So I would say the people who are involved at the management level should be maybe preparing the first draft of it, but being clear to the board as to how one links to the other, if you like, as I've already mentioned through those 3 slides per sector. If you can kind of join the dots for them, it allows them to make a more informed decision in relation to the, as you say, the review and approve stages. I would say it's probably unrealistic to expect them, unless you have specific risk management experts on your board, which some do, to be fair. I would say it's probably unrealistic to expect them to have done the preparation or the drafting stage. But I would say, please do spend the time explaining how one links into the other and how they do filter into, through to the on the ground business as usual, if you like, activities of everybody in the organization. Hopefully that answers the question. Hopefully I've answered all of the questions that have been addressed so far. If I haven't answered them fully, please do come back to me and redirect me if I've gone down a tangent, which, I have been known to do in the past. So I will not take offense if you want further clarity. Or, to be fair, if anything occurs to you, after, let's say, I'm conscious that I had a feeling it would be tight to deliver this in the 45 minutes. So please don't hesitate to follow up with a question if you want to send me an email. My email is on the last slide there, is shown on your screen at the moment, and it'll be on the slides when they get sent out to you. So please do follow up if anything I've said wasn't clear, or you'd like me to go back over anything in particular. Yes, I will be definitely sharing the PowerPoint. The PowerPoint will go out with the link to the recording of the session as well. So you'll get those in due course. You're very welcome. Okay. I'll just check. There's nothing else in the chat. No. And I think I've addressed all the questions that are there. So I'll give them a minute or two in case anybody else thinks of anything. I would have thought that probably would have populated it in by now if you had. Okay, you're very welcome. Thank you for the thank yous. I'm glad you enjoyed it. Um, so it's a topic that comes up over and over and over. So it's obviously one that people do struggle with. So try to bring a little bit of clarity. So hopefully that will have helped. Okay, guys, I think as soon as I've held you way longer with the questions and queries, we'll end it there. And say if you'd like to follow up with anything afterwards, please do.